Imagine waking up one morning thinking the global trade landscape is heading in one direction, only to find out a few days later it has completely flipped. That's exactly what just happened, because the United States has suddenly shifted gears on tariffs again. And this time, the consequences could be massive for electric vehicle companies, global supply chains, and especially for Aptera's future. This is one of those moments where policy whiplash isn't just a political headline, it's a real-world shakeup with ripple effects touching everything from market confidence to the price of an EV drivetrain. So let's break down what actually changed, why it matters, and what it means for Aptera over the next few months. Recently, the US government walked back most of the broad tariffs it had threatened to impose across dozens of countries. Those rates have now been brought down to 10%, which is still higher than before, but nowhere near the extreme levels that were on the table just days ago. At the same time, China's tariff rate has been pushed up dramatically to an astonishing 125%. This sudden pivot signals a complete change of strategy. Instead of opening economic battles with nearly every trading partner at once, the focus has now narrowed almost entirely to China. And honestly, that makes far more strategic sense. Starting a trade war with the entire world simultaneously is basically an invitation for every other country to just trade with each other and leave the United States standing alone. Becoming an economic island isn't exactly the winning move in a globally interconnected market. By narrowing the conflict to a direct US-China face-off, the administration is essentially saying this is where the real negotiation needs to happen. There are long-standing issues between the world's two largest economies: manufacturing, intellectual property, supply chain dependencies, and more. If this sharper focus works as a negotiation tactic and reduces tensions long-term, it could end up being beneficial. Financial markets certainly seemed relieved. The reaction was immediate. Stocks, including major indexes, saw a strong bounce after the announcement. Investors clearly preferred a targeted, somewhat predictable tariff structure instead of a chaotic clash with half the globe. But here's where things get interesting for Aptera. Because while the general reduction back to 10% helps relieve pressure on many EV manufacturers, the new tariff setup creates a very complicated situation for companies whose supply chains stretch across Europe, Korea, and especially China. Most of Aptera's major components originate from the EU. Before this change, those parts were staring down tariffs in the 20+% range. Now, Europe is back at a manageable 10%. South Korean components also returned to 10%, down from the mid-20s. That's a meaningful difference when you're building an ultra-efficient, cost-sensitive EV meant to compete at an affordable price point. But not everything Aptera sources comes from Europe or Korea. Some parts, such as certain air handling components, come directly from China. And then there's the biggest wild card, the Vitesco EMR3 drivetrain. While it is manufactured in China, there's uncertainty around whether it undergoes additional assembly or processing in Europe before being shipped to the US. If the drivetrain ends up being classified as a Chinese import under the new tariff policy, the 125% rate would more than double its cost instantly. That's not a small impact. That's a potentially deal-altering expense for an early-staged EV manufacturer fighting for every dollar of cost efficiency. And this is where the broader complexity starts to show. The previous proposed tariffs, near 50% for countries like Vietnam, Laos, Cambodia, and Madagascar, made little sense because those countries primarily export low-margin goods like textiles, clothing, or agricultural products. The US buys from them not because they are gaming the system, but because they simply can't afford to buy much from the US in return. Punishing extremely poor nations for exporting vanilla beans or inexpensive clothing helps no one. So yes, scaling all those back to a single standardized 10% is far more rational. But then there's the odd exception: fossil fuel imports. Those remain exempt from tariffs. Some believe this is tied to political influence from the fossil fuel industry, which has historically invested heavily in election cycles. Whether that's true or not, the exemption has real-world effects. By keeping fossil fuels tariff-free, fuel prices likely won't rise as much as they otherwise would. That's great for consumers, but ironically, not great for Aptera. High fuel prices tend to push consumers toward ultra-efficient vehicles. When gas is cheap, buyers are more likely to choose large SUVs instead of low-consumption EVs. It's a pattern that repeats every economic cycle. Gas spikes, everyone wants efficiency. Gas drops, everyone wants size. So, while reduced tariffs help Aptera on the production side, stable low fuel prices work against the demand side. And then comes the biggest challenge of all: uncertainty. Companies cannot plan against policy changes that swing dramatically within days. One moment, tariffs are about to hit half the world, and the next moment, that entire strategy evaporates while China's rate explodes upward. If a business can't predict the cost of its own parts even a few weeks out, forecasting becomes nearly impossible. Aptera, like every young EV startup, survives or dies based on capital. If markets stumble, investment appetite dries up. And when investors are losing money in turbulent markets, their willingness to fund high-risk startups drops to near zero. A shaky global economy is one of the worst environments for a company trying to ramp up manufacturing of a brand new vehicle platform. That's why today's policy reversal may actually be a net positive for Aptera. It stabilizes the broader economic mood, it calms markets, it reduces panic. And any sense of stability, even temporary, makes funding rounds and investor conversations easier. But the big question still hangs in the air. Will the 125% Chinese tariff hold? Probably not. It feels like a negotiating tactic, something set intentionally high so future talks can walk it back to a more reasonable rate while allowing both sides to declare victory. As long as these policies remain in flux, companies like Aptera face a real challenge. They need stability, they need clarity, they need a predictable environment to finalize their cost structures and move into serious production. And right now, it feels like every week brings a new twist to the global trade landscape. There's a scenario where things stabilize, tariffs settle into a consistent pattern, the trade dispute resets, and companies can finally plan with confidence. There's another scenario where this volatile cycle continues, reshaping supply chains week by week. No one knows which one we're headed toward. But for today, Aptera at least gets a moment of relief. Lower tariffs on most of its supply chain partners, combined with a more optimistic market environment, could help support the company's ongoing search for financing. And with a startup as innovative and as vulnerable as Aptera, every piece of good news matters. The coming months will reveal whether this is a temporary pause or the start of a more stable policy direction. Either way, the stakes are high, not just for Aptera, but for every EV manufacturer navigating a rapidly shifting global economy. Until then, the only certainty is uncertainty, and how companies adapt to it will determine who survives the next chapter of the electric revolution.